Everyone saw the chart. Supermicro computer, ticker SMCI, ripped for months and then just got crushed. But here's what most people don't realize. This wasn't a normal sell-off. This was a signal. And if you don't understand what actually triggered it, you're going to miss the bigger story playing out right now. See, I've been tracking this company for months, and 2 weeks ago I warned you something didn't add up. Now it's unfolding in real time. But while most people are panicking, guessing, or buying the dip, I'm going to show you exactly what's happening and why it's not over. Because this report is not just bad, it exposes the flaw in the entire SMCI narrative. And once you see what's inside the numbers, you won't look at this stock the same way again. Let's get into it. SMCI just posted its biggest quarter ever, $5.76 billion in revenue, up 25% from last quarter, up 8% from last year. And on the surface, that sounds impressive, but underneath, it's falling apart. Non-GAAP EPS came in at 41 cents. That's not a typo, that's down from 54 cents last year. Margins down, profits shrinking, and nobody's talking about it. Gross margin was 9.6%, operating margin just 5.3%. Let me put that in perspective. They're doing billions in sales and keeping 5 cents on every dollar before paying interest and taxes. That's not dominance, that's deterioration. Because if the business is growing and the profits aren't, then what the hell are you scaling? The answer, volume, not value. And volume without pricing power isn't strength, it's exposure. They're moving fast but bleeding margin, and in this game that doesn't end well. Everyone's saying SMCI is printing cash. Wrong. It's not a cash machine. It's a debt machine that happens to be holding cash. They just pulled $864 million in operating cash flow. Sounds impressive, right? Until you realize they also raised $2.3 billion in convertible debt and sold off $1.8 billion of accounts receivable to pad the numbers. That's not performance, that's patchwork. You don't raise billions in debt and dump receivables if you're sitting pretty. You do that when you're overextended and need oxygen. SMCI now has $5.2 billion in cash, but $4.8 billion in debt. That leaves them with just $412 million net, which is nothing when you're spending at this scale. And let's be real, this isn't a high-margin software business. They're running a global, low-margin, hardware-intensive operation. The moment growth slows, this entire structure starts to shake. That's the part nobody's talking about. Everyone sees the cash, nobody sees the risk it took to get it. And that risk is rising, not falling. Everyone's hyped about the tech, the racks, the cooling, the partnerships with NVIDIA and AMD. They talk about SMCI like it's building something nobody else can copy. But here's the truth, there's no real moat here. This is hardware, and hardware always commoditizes. But here's the truth, there's no real moat here. This is hardware, and hardware always commoditizes. And if you can't defend your margin, you don't control the game. SMCI is moving fast. Sure, they've got new data center build-outs, liquid cooling systems, pre-configured racks, but they're not the only ones doing it, and none of it, not one piece, is proprietary. They're calling it a total IT solution. What it really is, commodity parts packaged at scale. Anyone with capital can replicate it, and when the only edge you have is speed, someone faster will eventually show up. Want proof? Look at the margins. If customers truly value the solution, they'd pay more for it. But margins are falling, not rising. That means the product isn't getting more valuable, it's getting easier to replace. And when your product gets easier to replace, you become easier to ignore. SMCI raised guidance. That's what the bulls are clinging to. They're calling for at least $33 billion in revenue for fiscal 2026. First quarter revenue projected between $6 and $7 billion. Sounds bullish, right? But here's the catch. None of that growth is margin expanding. Their own guidance implies EPS will stay flat. And if margins don't move up, that growth is just more revenue with more risk. Why is that happening? Because some of this revenue was delayed. Their 10K filing got pushed back. A major customer changed specs mid-cycle, so those orders didn't vanish. They just slid into the next quarter. So yes, revenue is backloaded, but it's not organic growth, it's cleanup. And when a company pads forward guidance with delayed execution, that's not strength, that's catch-up mode. The risk here isn't that they miss guidance, it's that they meet it, and the business still looks worse, because hitting the top line means nothing if your margins suck, and debt keeps climbing. This isn't about how much they sell, it's about how well they convert it, and right now there's no leverage in the model. Let's be fair, Let's lay out both sides because this is where most people get confused. They hear the story, but they don't separate height from leverage. So here's the bull case and here's the bear case. The bull case says SMCI is riding the AI infrastructure wave. They've got demand, they're expanding globally, they're the first to ship racks, the first to integrate NVIDIA's latest platforms, and they're forecasting $33 billion in sales. From the outside, it looks like a rocket ship. But here's the bear case, and it's stronger. There's no pricing power, margins are falling, free cash flow is propped up by debt, and the product not differentiated. Anyone with money can copy this model. That's not a moat, that's a time bomb. Even worse, SMCI now holds $4.7 billion in inventory. That's nearly $1 billion more than last quarter. If growth slows, those racks don't sell. That inventory turns into deadweight, and deadweight destroys balance sheets. So here's the bottom line. SMCI is scaling, but it's scaling a business that's already leaking margin. There's no product lock-in, no premium pricing, no operational leverage. And for me, that's not a stock I want to own. 2 weeks ago, I said SMCI had no pricing power, no moat, no margin expansion, and back then the stock was up 70% in just a few months. I called it a hard pass, and the Karens came out in force. They said I didn't get it. They said I was missing the story. They said I'd regret it. I don't regret it because everything I said just got confirmed. Margins are still falling, debt is rising, inventory is exploding, and the so-called competitive advantage, nowhere to be found. And Wednesday, SMCI was down over 18%. I called this 2 weeks ago. So let me be clear, my thesis is currently bearish. I have zero interest in owning this stock based on what I just saw in this earnings report. This isn't an emotional take. It's not about belief. It's about math. It's about leverage. And this business has none. My non-financial for entertainment advice, put your money into something you believe in, something with margin, with pricing power, with control. This isn't it for me. Because at the end of the day, the question is simple. Is the business getting stronger every quarter? No. Are the numbers trending up across customers, contracts, and cash flow? Not in a meaningful way. Is the product becoming harder to compete with? Absolutely not. That's all I need to know. So let me ask you something. Who else is breaking down SMCI's earnings with real analysis while showing you how to spot the trap before it triggers? Who else gives you both the bull and the bear case, lays out the thesis, and then follows through with the trades that actually make money? Nobody. 2 weeks ago, I said SMCI was running on hype. I said it had no pricing power, no moat, and no leverage. People tore into me for it, but the numbers just confirmed it. I'm not buying the dip. I'm walking away. And it's not just me. I passed $2.15 million in profits this year. It's only August and I'm up over 61% year to date. This isn't theory, it's execution. Inside my Patreon, people aren't watching charts, they're pulling income. Palo Market made $5,800 last month, his third month trading options. Another member cleared $6,654.82 in July alone, stacking exits like a machine. And another member joined the Diamond tier 3 weeks ago, made 3 investments and already covered the full annual fee. The next 49 weeks, pure profit. You can't fake that. Here's what you get inside. Real-time trade alerts with breakdowns, entry, exits, and why. Daily market analysis that cuts the noise, the exact strategies I'm using to scale a 7-figure portfolio with options and momentum. It's $30 a month. Most people spend more than that letting Netflix autoplay. This could actually pay you back. If it doesn't sharpen your strategy, grow your account, and give you more confidence in every trade, cancel anytime. No pitch, no pressure. But if you've been watching this channel nodding along, telling yourself, I should join, this is your moment. Because the truth is simple. You can scroll or you can scale. But either way, don't say you weren't told.